It starts with a simple, almost childlike observation. You walk into a store, you see a product on the shelf, and you think, I love this. Maybe it's a can of Coca-Cola. The perfect balance of sweet and fizz that has defined refreshment for a century. Maybe it's the iPhone in your pocket. A seamless portal to the entire world. A marvel of design and engineering. Maybe it's the efficiency of an Amazon delivery. A box appearing on your doorstep seemingly hours after you thought of wanting its contents. And from that love, an idea forms, this is a great product, so it must be a great company, I should invest in it. This is the logic of millions. It's the starting point for countless brokerage accounts. It's the well-meaning advice passed down from generation to generation. And according to Warren Buffett, it is one of the most reliable paths to financial disappointment. It is a critical, costly, and fundamental misunderstanding of what a business actually is. Because a business is not its product. A business is a machine for converting capital into more capital. That is its sole purpose. The product, the service, the brand, these are just the mechanisms the machine uses. But the machine itself, the engine that drives everything, is management. And the person with their hands on the controls of that machine is the chief executive officer. What Buffett understood decades before it became a mainstream idea in finance is that in the long game of wealth creation, the quality of the product is a distant second to the quality of the CEO's decision-making. Specifically, their skill at one single, all-important task, capital allocation. It's a term that sounds like dry business school jargon, but it is the most potent and predictive variable in all of long-term investing. It is the art and science of answering one question over and over again, year after year: what do we do with the money we've earned? The answer to that question separates the companies that compound into legendary fortunes from the ones that stagnate, that tread water, and that ultimately sink, taking shareholder capital down with them. Most investors spend their time analyzing the product. They read reviews, they study industry trends, they try to predict the next hot gadget. Buffett spends his time analyzing the person who decides what to do with the profits from that gadget. Because a brilliant product in the hands of a CEO who is a poor capital allocator is like a fire hose of cash aimed directly at a bonfire. The money comes in, but it gets incinerated by dumb acquisitions, ill-timed stock buybacks, or wasteful vanity projects. Conversely, a good but not great business in the hands of a genius capital allocator can become an unstoppable compounding machine, turning every dollar of profit into $2, then $4, then $8 of market value for its owners. This is the great secret hiding in plain sight within Berkshire Hathaway's success. It's not about finding the next Apple or Google. It's about finding the next Tom Murphy or Katharine Graham. It's about learning to grade a CEO not on their charisma in a television interview, but on the cold, hard, mathematical results of their capital allocation decisions over a decade. The market is littered with the ghosts of companies that had beloved products but were run by managers who destroyed shareholder value. And it is built on the foundations of businesses run by leaders you've likely never heard of, who quietly and rationally made a series of smart decisions with company cash that compounded into fortunes. Today we are going to learn how to tell the difference. We will deconstruct Buffett's framework for management analysis. You will learn how to look at a company's leadership as its most important asset, or its most crippling liability. This isn't about stock tips. This is about acquiring a mental model, a permanent lens through which to view any business that will fundamentally change your investment strategy and give you an edge over the 99% of market participants who are still just looking at the product on the shelf. This is the key to unlocking true long-term shareholder value and achieving the kind of financial freedom that comes not from guessing, but from understanding. Our journey begins with the bedrock principle, the absolute foundation upon which all other analysis rests. It is the realization that the CEO's primary job is not to be a great operator, a visionary marketer, or a beloved public figure. Their primary job is to be an intelligent manager of capital. This distinction is the starting point for all value investing. An operator makes sure the factories run on time, the products are high quality, and the customers are happy. This is vital, of course. But the capital manager's job begins where the operator's ends. At the end of the year, when all the costs have been paid and the profits are sitting in the company's bank account, the capital manager faces a series of choices that will determine the entire future of the enterprise. This is the moment of truth. And to understand what genius looks like in this moment, we must turn the clock back to the 1960s and tell the story of the man Warren Buffett considers the greatest business manager he has ever known, a man whose approach to capital allocation became the blueprint for Berkshire Hathaway itself, Tom Murphy of Capital Cities Broadcasting. The story doesn't start with a flashy tech startup or a global brand. It starts with a bankrupt UHF television station in Albany, New York in 1954. This station, WROW-TV, was a financial disaster. It was bleeding cash. But a man named Frank Smith saw potential. He pulled together a group of investors, including a bright 29-year-old Harvard Business School graduate named Thomas S. Murphy, and bought the station for a mere $300,000. Murphy was brought in to run it. From day one, he established a culture that was the polar opposite of the lavish, free-spending world of broadcast media. He was fanatically frugal. He famously shared a secretary with his station manager. He answered his own phone. He scrutinized every line item of the budget, asking not just, "Is this necessary?" but "Is there a cheaper way to get this done?" This wasn't just about saving money. It was about instilling a mindset. The company's cash was a precious, finite resource. It was the shareholders' money, not a corporate slush fund. This operational excellence made the Albany station profitable. And here is where the story of capital allocation begins. A typical manager, having turned around the station, might have rewarded himself with a bigger office, a corporate jet, or a fancy headquarters. Tom Murphy did the opposite. He took the profits from the Albany station and, along with his partners, went looking for another underperforming station to buy. They found one in Durham, North Carolina, then another in Providence, Rhode Island. Each time the formula was the same: buy an undervalued media property, install their lean, decentralized management system, make it highly profitable, and then use the cash flow from the growing collection of stations to buy another one. Murphy wasn't trying to build an empire. He was running a private investment fund where the assets just happened to be television and radio stations. Every dollar of profit was evaluated on its potential to generate more profit. This relentless focus on return on investment was the core of their business analysis. The masterstroke, the deal that cemented Tom Murphy's legend and caught the permanent admiration of Warren Buffett, came in 1985. By this time, Capital Cities was a successful but still relatively small media company. Murphy and his partner, Dan Burke, decided to do something audacious. They decided to acquire ABC, the American Broadcasting Company. At the time, this was like a piranha swallowing a whale. ABC was 4 times the size of Capital Cities. The price tag was a staggering $3.5 billion. One of the largest media mergers and acquisitions in history at that point. Wall Street was skeptical. The media world was shocked. How could this small, frugal company possibly digest such a massive, bureaucratic, and famously lavish network? But Buffett, who helped finance the deal by having Berkshire Hathaway buy $517 million of Cap Cities stock, knew exactly why it would work. He wasn't betting on the ABC brand or its lineup of shows. He was betting on Tom Murphy's proven skill as a capital allocator and operator. And Murphy did exactly what he had always done. He applied the same ruthless financial discipline to the sprawling ABC empire that he had to that tiny Albany station 30 years earlier. He sold off assets that weren't generating sufficient returns. He cut extravagant perks, famously questioning the need for private dining rooms for executives. He decentralized management, pushing authority and accountability down to the local station level. He focused every division on profitability and cash flow. The results were astounding. The combined company, Capital Cities/ABC, became a powerhouse of profitability. The stock soared. For Buffett and Berkshire Hathaway, their investment was a home run, cementing a partnership and a friendship that would last a lifetime. Buffett would later say of Murphy, He is the best business manager I've ever met. It's a tragedy that he is not cloned. The story of Tom Murphy is the quintessential illustration of the CEO as a capital manager. He understood that his job was not just to run TV stations, but to take the capital they produced and deploy it in a way that would generate the highest possible long-term return for his shareholders. He treated the company's money as if it were his own, a trait that seems obvious but is shockingly rare in the world of executive decision-making. So why is this approach so rare and so powerful? The answer lies deep in the wiring of the human brain and the structure of corporate America. The underlying psychological principle at play here is known as the agency problem, a core concept in economics and finance. In any large corporation, the owners, the shareholders, or principals are separate from the people who run the company, the managers, or agents. In a perfect world, the agents would always act in the best interests of the principals. But we don't live in a perfect world. The CEO's personal incentives are often divorced from the long-term goal of maximizing shareholder value. Consider the typical CEO. Their compensation is often tied to the size and growth of the company. A bigger company means a bigger salary, a larger bonus, more prestige, and a more impressive legacy. This creates a powerful psychological drive towards empire building. The CEO's ego and bank account are both served by making the company larger, even if that growth comes at the expense of profitability. They might pursue a flashy, expensive acquisition not because it's a smart use of capital, but because it will get them on the cover of a magazine. This is a classic cognitive bias in action, overconfidence, and a desire for social proof. They see other CEOs doing big deals and feel compelled to do the same, falling into a herd mentality. They become obsessed with revenue growth, often ignoring the more important metric of profit per share. This is the path of value destruction. Buffett's genius was to seek out CEOs who had somehow short-circuited this flawed psychological wiring. He looks for managers who think like owners, not like hired hands. Tom Murphy thought like an owner because he was a significant owner. His personal wealth was tied directly to the performance of the company's stock, not to the size of its org chart. This alignment of interests is the most powerful antidote to the agency problem. An owner-operator doesn't care about the size of the empire, they care about the value of their equity. They are not tempted to overpay for an acquisition with the shareholders' money, because it's also their money. They are not going to spend lavishly on corporate jets and opulent headquarters, because they feel that expense coming directly out of their own pocket. This mindset changes everything. It transforms capital allocation from an exercise in ego gratification to a rational process of wealth maximization. Buffett searches for this owner-like mentality. Whether the CEO is a founder with a huge stake in the company, or a professional manager who simply has the character and integrity to treat shareholders' money with the same care they would their own. So how can we, as individual investors, translate this powerful principle into a practical tool for business analysis? We can create a mental model, a blueprint for evaluating any CEO's capital allocation skill. Let's call it the 5 choices framework. Every single dollar of profit that a company generates presents its CEO with 5, and only 5, possible paths. A great CEO understands these 5 paths intimately and constantly weighs them against each other. A poor CEO often only considers 1 or 2, or makes the choice based on emotion and ego. The first choice is to reinvest that dollar back into the company's existing operations. This is organic growth. It could mean building a new factory, spending more on research and development, or launching a new marketing campaign. This is often the best possible use of capital if the business can earn high rates of return on that new investment. A company like See's Candies or Geico, as we'll see later, could reinvest profits and generate spectacular returns. But for a business in a slow-growing or highly competitive industry, like a railroad or a utility, there might be very few opportunities for high-return internal reinvestment. A smart CEO knows when to say no to internal expansion, recognizing that plowing more money into a low-return business is like adding water to a leaky bucket. The second choice is to use that dollar to acquire another business. This is the path of mergers and acquisitions, M&A. This is the quickest way to grow, but it is also the most dangerous. As Buffett has said, most acquisitions fail to create value for the acquiring company's shareholders. The allure of empire building is strong, and CEOs often get caught up in deal fever, leading them to drastically overpay. A master capital allocator approaches acquisitions with extreme caution, waiting for the perfect opportunity at a sensible price, like Tom Murphy's purchase of ABC. The third choice is to return the dollar to shareholders in the form of a dividend. This is a direct, tangible return of capital. For mature, stable companies that generate more cash than they can intelligently reinvest, paying a steady and growing dividend is a sign of financial leadership and discipline. It's an admission from management that the shareholders can likely find a better use for that capital than the company can. The fourth choice, and one of the most powerful and misunderstood, is to use that dollar to buy back the company's own stock. If a company's stock is trading in the market for less than its intrinsic business value, then buying back shares is an instantly accretive act for the remaining shareholders. It's like buying a dollar bill for 80 cents. A great CEO understands this math and will act aggressively when the opportunity arises. A poor CEO will often do the opposite, buying back shares at market peaks to prop up the stock price. The fifth and final choice is to use that dollar to pay down debt. This strengthens the balance sheet, reduces interest expense, and lowers the overall risk profile of the company. In times of uncertainty, or when a company has taken on too much leverage, this is often the most prudent and value-creating choice of all. The blueprint for us as investors is to look at a company's history, say the last 5 or 10 years, and see how its management has allocated capital across these 5 choices. Read the annual reports. Look at the cash flow statements. Did they pour billions into an acquisition that later had to be written down? Did they buy back stock when it was expensive, or when it was cheap? Did they reinvest heavily in a business that earns low returns? Or did they demonstrate a rational, flexible, and opportunistic approach, consistently choosing the path that created the most long-term value per share? The answers to these questions are far more predictive of future stock performance than any product review or industry forecast. They are the report card of the CEO as a capital manager. To truly appreciate the genius of this approach, we must spend time examining its opposite, the path of the 99%. This is the world of the empire builder CEO, the charismatic leader who graces magazine covers and delivers inspiring speeches while quietly, or sometimes openly, destroying shareholder value. The cautionary tale that stands above all others is the disastrous merger of AOL and Time Warner in the year 2000. It is the perfect antithesis to Tom Murphy's disciplined acquisition of ABC. At the peak of the dot-com bubble, AOL was the king of the internet, a high-flying company with an astronomical stock market valuation. Time Warner was an old media behemoth, owning everything from Warner Brothers Studios and HBO to Time Magazine and CNN. Steve Case, the CEO of AOL, and Gerald Levin, the CEO of Time Warner, were hailed as visionaries for putting together this merger for the new millennium. They spoke of synergy, of convergence, of a future where AOL's online distribution would seamlessly merge with Time Warner's world-class content. It was a grand vision, and the market bought it completely. But the deal was a catastrophe of capital allocation from the very beginning. It was driven by ego and a desperate fear of being left behind in the new digital age. Gerald Levin of Time Warner in particular was so enamored with the idea of a digital legacy that he agreed to an all-stock deal that massively overvalued AOL and diluted his own shareholders into oblivion. There was no rigorous business analysis, no margin of safety. It was a bet-the-company move based on a flimsy narrative and an inflated stock price. The synergies they promised never materialized. The cultures of the two companies were oil and water. The aggressive, fast-moving internet culture of AOL clashed violently with the staid, bureaucratic hierarchy of Time Warner. The financial consequences were breathtaking. Just 2 years after the merger closed, the company was forced to take a goodwill impairment charge of nearly $100 billion. It remains one of the largest annual losses ever reported by a company. The market capitalization of the combined entity collapsed by over $200 billion. Fortunes were wiped out. The visionary CEOs were disgraced. It was a textbook example of an empire-building acquisition that destroyed an astonishing amount of shareholder value. The focus was on size, on narrative, on being the biggest. The fundamental questions of capital allocation, what are we buying, what are we paying, and what is the likely return on this investment, were ignored in the euphoric rush to build a media empire. This is the path of the 99%, chasing growth at any cost, prioritizing narrative over numbers, and allowing ego and herd mentality to drive executive decision-making. The difference between the Tom Murphy approach and the AOL Time Warner approach manifests directly and powerfully on a company's financial statements. The direct financial connection can be measured and tracked using a single powerful metric: return on invested capital, or ROIC. ROIC tells you how much profit a company generates for every dollar of capital that has been invested in the business. A high ROIC means that management is extremely effective at deploying capital into projects that generate strong returns. A low or declining ROIC is a giant red flag that the CEO is a poor capital allocator, squandering the owner's capital on low-return projects or value-destroying acquisitions. Let's imagine two companies, Company A and Company B. Both generate $100 million in profit this year. On the surface, they might look similar. But Company A achieved this profit using $500 million of invested capital, giving it an ROIC of 20%, $100 million per $500 million. Company B needed $2 billion of invested capital to generate the same $100 million profit, giving it a dismal ROIC of 5%, $100 million per $2 billion. Company A is a far superior business and is run by a much better capital allocator. Now let's see what happens next. Both CEOs decide to reinvest all $100 million of profit back into their businesses. The CEO of Company A, being a skilled allocator, finds projects that earn the company's typical 20% return. That $100 million investment will generate an extra $20 million in profit next year. The CEO of Company B, however, continues to find low-return projects. His $100 million investment will only generate an extra $5 million in profit. After just 1 year, Company A is generating $120 million in profit, while Company B is generating $105 million. The gap will widen exponentially over time. This is the mathematical magic of compounding, driven entirely by the CEO's skill in capital allocation. A CEO who consistently allocates capital at high rates of return creates a compounding machine for shareholder value. A CEO who allocates capital at rates below the company's cost of capital is actively destroying the business, even if revenues are growing. Learning to focus on ROIC instead of just revenue or earnings growth is a fundamental step towards implementing a truly effective, Buffett-style investment strategy. It is the financial scoreboard for capital allocation. One of the most powerful and yet publicly maligned tools in the capital allocator's toolkit is the stock buyback. To the 99%, buybacks are often seen as a form of financial engineering, a trick used by corporate executives to manipulate earnings per share and enrich themselves. And in the hands of a poor capital allocator, that is often exactly what they are. But in the hands of a master, a rational and disciplined stock buyback program is one of the surest and most tax-efficient ways to create enormous value for long-term shareholders. To understand this, we must go back to another of Buffett's most famous and instructive investments, his involvement with the Washington Post Company and its legendary leader, Katharine Graham. In the early 1970s, the Washington Post Company went public. Its crown jewel was, of course, the newspaper itself, a dominant franchise in a major city. But the company also owned other valuable assets, including Newsweek magazine and several television stations. Shortly after the IPO, the stock market entered a brutal bear market. By 1973, the stock price of the Washington Post had fallen so far that the entire company's market capitalization was only around $80 million. Buffett, through his meticulous fundamental analysis, did a quick calculation. He realized that the television stations alone were likely worth more than $80 million. In essence, an investor buying the stock at that price was getting the entire Washington Post newspaper and Newsweek magazine for free. It was a classic Buffett situation, a wonderful business trading at a ridiculously cheap price. He began buying the stock aggressively for Berkshire Hathaway, quickly accumulating a stake of over 10%. This made him a major shareholder and gave him a seat on the board of directors. He developed a close friendship and mentorship with Katharine Graham, the company's chairman and CEO. Kay Graham was a brilliant and courageous publisher, famous for her decision to publish the Pentagon Papers and for overseeing the Watergate investigation. She was a titan of journalism, but when it came to finance and capital allocation, she was less confident. And this is where Buffett provided the crucial insight. He saw that the Washington Post was a phenomenal business that gushed cash. It didn't require much capital to run, so at the end of every year, there was a large pile of profit left over. The company had been using this cash to make acquisitions, diversifying into businesses it didn't understand, as well as its core media properties. Buffett saw a much better use for the cash. He explained a simple concept to Graham. The company's stock was trading at, say, $20 per share, but he believed its intrinsic value, what a rational private buyer would pay for the whole business, was closer to $80 per share. Therefore, every time the company used its cash to buy back one of its own shares at $20, it was effectively making a 400% return on that investment for the remaining shareholders. The value of the company didn't change, but the number of ownership slices was reduced, making each remaining slice proportionally more valuable. It was a powerful, mathematically undeniable argument. Convinced by Buffett's logic, Kay Graham and her management team began a systematic program of stock buybacks. Over the next several years, they used the company's excess cash flow to repurchase a significant percentage of their shares outstanding, all at prices far below intrinsic value. This single capital allocation decision had a massive impact on long-term shareholder returns. As the company's earnings grew and the market eventually recognized its true value, the stock price soared. The reduced share count acted as a powerful accelerant. For every dollar the company earned, the earnings per share were now much higher. The long-term shareholders who held on, like Berkshire Hathaway, saw their investment compound at a spectacular rate. It was a masterclass in rational stock buybacks, a perfect example of shrinking the pie to grow the size and value of each slice. The psychological principles that prevent most CEOs from acting this rationally are subtle but powerful. The first is a deeply ingrained growth imperative, a form of the endowment effect. CEOs are builders. Their instinct is to add things, new divisions, more employees, larger revenues. The idea of shrinking the company, even just the share count, feels counterintuitive. It can feel like a retreat, an admission that they can't find better ways to grow the business. It takes a rare form of intellectual honesty and emotional discipline to admit that the single best investment available in the entire market is the company's own underpriced stock. Furthermore, many executives fall victim to loss aversion and confirmation bias when it comes to their own company's stock. They are psychologically primed to believe their company is doing well and that its stock should be going up. When the stock price falls, they often view it as an irrational market anomaly, but they are hesitant to act on it. Then, when the stock price is high and the business is receiving accolades, their confirmation bias kicks in. They see the high price as validation of their brilliance and believe it will go even higher. This leads to the perverse and value-destroying behavior of buying back stock at market peaks when it is most expensive and stopping buybacks when the stock is cheap and the opportunity is greatest. Buffett and Graham did the exact opposite. They acted when there was blood in the streets, when pessimism was rampant, and when the mathematical gap between price and value was at its widest. They overrode the emotional short-term instincts that govern most executive decision-making with cold, long-term logic. How can we as investors determine if a company's buyback program is a sign of intelligent capital allocation or a red flag of managerial folly? We can use a simple mental model, the buyback litmus test. It's a short checklist of questions to ask about any company that is repurchasing its shares. First, and most importantly, is the stock trading at a meaningful discount to its intrinsic value? This is the foundational question. A buyback is only value creative if the price paid is less than the value received. Buying back stock at fair value is a neutral act. It's like trading a dollar bill for 4 quarters. Buying back stock above intrinsic value actively destroys shareholder value. It's like trading a dollar bill for 3 quarters. As an investor, you have to do your own fundamental analysis to estimate the intrinsic value of the business. If a company is buying back billions of dollars worth of stock at a price-to-earnings ratio of 40, it is highly likely that they are overpaying and destroying value. If they are buying it back at a PE of 10, when the business is stable and growing, it is far more likely to be a smart move. Second, does the company have excess cash after funding all of its high-return internal projects? The first priority for a company's cash should always be to reinvest in its core business, but only if those reinvestment opportunities offer attractive returns. A company should not be starving its R&D budget or neglecting factory maintenance just to fund a stock buyback. The cash used for buybacks should be true surplus capital, money that is left over after all sensible operational and strategic needs have been met. Third, what is the motivation behind the buyback? Is it a genuine, long-term strategy to increase per-share value for owners, or is it primarily being used to offset the massive dilution caused by executive stock options? Many technology companies, for example, issue huge amounts of stock to their employees as compensation. They then use corporate cash to buy back a similar amount of stock in the open market. The net effect is that the share count doesn't actually decrease. In this case, the buyback isn't rewarding shareholders at all. It's just a way of funding employee compensation with the owner's capital. You need to look at the change in the net shares outstanding over several years to see if the buyback program is actually shrinking the shareholder base. A genuine, value-creating buyback program will result in a steady and significant decline in the number of shares outstanding over time. Applying this litmus test allows you to cut through the noise and PR surrounding buyback announcements and perform a real management analysis of the CEO's intentions and financial acumen. It separates the disciplined capital allocators from the manipulators. The opposite of this disciplined approach is what we see all too often in the market. It is the path of the 99%, the pro-cyclical buyback spree. This is the herd behavior of buying high and selling low, applied at a corporate level. During a bull market, when profits are flush and stock prices are hitting all-time highs, companies feel immense pressure from Wall Street to do something with their cash. Analyst reports will criticize them for having lazy balance sheets. So what do? They announce massive stock buyback programs. They pour billions of dollars into repurchasing their own shares at the highest possible prices, effectively getting the worst possible return on their investment. Then, the inevitable happens. The economy turns, a recession hits, and the stock market crashes. The company's stock price might fall by 50% or more. This is the moment of maximum opportunity, the time when a buyback would be most accretive to long-term value. But what do these same companies do? They cancel their buyback programs. They are now worried about conserving cash to survive the downturn. They might even be forced to issue new shares at deeply depressed prices just to shore up their balance sheets, massively diluting the very same shareholders they were supposedly rewarding a year earlier. This pattern repeats itself in almost every market cycle. Look at the data from 2007, at the peak of the last bull market, and you will see a record level of stock buybacks. Look at the data from the bottom in early 2009, and you will see that buybacks had all but disappeared. This is the definition of value-destructive behavior. It is buying high and panicking low. A CEO who follows this pattern is demonstrating a complete lack of independent thought and financial discipline. They are not acting like a rational long-term owner. They are acting like a panicked short-term trader. Identifying this behavior is one of the clearest signals to avoid a company's stock, regardless of how good its products might seem. The direct financial connection of a well-executed buyback program is one of the most elegant and powerful forces in finance. Earnings per share, EPS accretion. The math is simple, but its effect is profound. Imagine a company, Rational Corp. It has net earnings of $1,000 and there are 100 shares of its stock outstanding. Its earnings per share, EPS, is calculated by dividing the earnings by the number of shares. $1,000 per 100 shares equals $10 EPS. Let's say the stock trades at 10 times earnings, giving it a stock price of $100 per share. Now, the CEO of Rational Corp., a student of financial leadership, determines that the stock is trading below its intrinsic value and that the company has $1,000 in excess cash. Instead of making a risky acquisition, the CEO decides to use that cash to buy back 10 shares at the market price of $100 each. The company now has spent its $1,000 in cash, and there are only 90 shares of stock outstanding. Next year, let's assume the business operations don't change at all. The company still earns $1,000 in profit. But now, when we calculate the EPS, the math is different. $1,000 in earnings / 90 shares equals $11.11 EPS, without any improvement in the underlying business. The earnings attributable to each share have increased by over 11%. If the market continues to value the stock at 10 times earnings, the new stock price would be $111.10. The shareholders who didn't sell have seen the value of their holdings increase by 11.1%, purely as a result of the CEO's intelligent capital allocation decision. This is not financial trickery. It is the mathematical reality of making each ownership stake larger by reducing the number of stakes. Over many years, a consistent and intelligent buyback program can be the single greatest driver of shareholder value, especially for mature companies that generate more cash than they can reinvest at high rates. It is the hallmark of a CEO who is truly focused on maximizing long-term per-share value. If stock buybacks are a tool for surgical value creation, then mergers and acquisitions, or M&A, are the corporate equivalent of heavy artillery. In the right hands, aimed at the right target, they can win the war. In the wrong hands, they are far more likely to inflict devastating friendly fire, wiping out billions of dollars of shareholder capital in a single, misguided campaign. No area of capital allocation requires more discipline, and no area is more corrupted by the ego and empire-building tendencies of the average CEO. Buffett's approach to acquisitions is therefore defined not by enthusiasm but by extreme, almost paralyzing caution. He is famous for his mantra of hunting for elephants, meaning very large acquisitions, but his true genius lies in his willingness to go years without firing a shot if the right target at the right price doesn't appear. To understand his discipline, we must examine the single most important acquisition in Berkshire Hathaway's history, the one that provided the model and the cash for everything that followed: See's Candies. In 1972, Warren Buffett and his partner Charlie Munger were presented with an opportunity to buy a family-owned premium chocolate company based in California. See's Candies was a beloved brand with a loyal customer base and a strong reputation for quality. It was a good business, but it wasn't a fast-growing tech company. It was, in many ways, a boring business. The See family wanted to sell, and their asking price was $30 million. Buffett and Munger did their analysis. The company had about $8 million in tangible assets, factories, inventory, and so on. It was earning about $2 million in profit after tax. From a purely quantitative perspective, paying $30 million seemed high. Many value investors of that era, trained in the cigar butt school of Ben Graham, would have walked away. They were used to buying businesses for less than their liquidation value. But Buffett and Munger saw something else. They saw an intangible asset that didn't appear on the balance sheet, a powerful brand that created immense customer loyalty. This brand gave See's pricing power. They could raise the price of their chocolates every year to keep up with inflation, and their customers wouldn't flee to a cheaper competitor. This pricing power, combined with the fact that the business didn't require much new capital to grow, meant it was a cash-generating machine. After some negotiation, they agreed on a price of $25 million. It was the largest acquisition Berkshire had ever made at the time, and Buffett would later admit he was nervous about paying that much. That $25 million investment has since become the stuff of legend. Over the decades, See's Candies has generated more than $2 billion in pre-tax earnings for Berkshire Hathaway, all of which has been available for Buffett to allocate to other investments. That initial investment has been returned more than 80 times over. But its true value was not just the cash it produced. The See's acquisition fundamentally changed Buffett's investment strategy. It taught him that it was better to buy a wonderful business at a fair price than a fair business at a wonderful price. It shifted his focus from the purely quantitative cigar butts to a more qualitative analysis of a business's long-term competitive advantages, or what he would later call its moat. See's became the prototype for the kind of business Berkshire would look to acquire, a company with a strong brand, pricing power, and low capital requirements. It was the disciplined acquisition that provided the intellectual and financial flywheel for the next 40 years of Berkshire's growth. The psychological trap that Buffett and Munger avoided with See's is one that ensnares countless CEOs in the M&A market. It's a powerful cognitive bias known as the winner's curse. In any auction or competitive bidding situation, the winner is often the person who most overestimates the value of the item being sold. In the world of corporate acquisitions, multiple companies will often compete to buy a hot target company. Investment bankers whip up a frenzy. The media covers it like a horse race. The CEOs involved get their competitive juices flowing. The desire to win the deal can overwhelm the rational analysis of what the business is actually worth. The company that ultimately wins the auction often does so by paying a price so high that it is almost impossible to generate a decent return on the investment. Their victory is, in fact, a curse. This is amplified by the herd mentality that pervades corporate boardrooms. If a competitor announces a big deal, the board and the CEO might feel immense pressure to do a deal of their own, just to keep up. This fear of missing out drives a wave of ill-conceived mergers and acquisitions, particularly near the peak of a market cycle. Buffett's antidote to the winner's curse and herd mentality is his unwavering patience and his concept of a margin of safety. He calculates what he thinks a business is worth and will not pay a penny more. He doesn't care if a competitor buys it for a higher price. He is happy to sit on the sidelines, holding cash, for years if necessary, waiting for the perfect pitch. This emotional detachment from the outcome is a psychological superpower in the high-stakes, high-ego world of M&A. To bring this discipline to our own investment analysis, we can use a mental model called the acquisition scorecard. When a company you own or are thinking of owning announces a major acquisition, you can grade the decision using this framework. First, evaluate the target company. Does it have a durable competitive moat? Is this a truly wonderful business like See's Candies, with a strong brand, pricing power, or a low-cost advantage? Or is it a mediocre, commodity-type business in a highly competitive industry? Acquiring a bad business rarely turns out well, no matter how cheap the price. Second, evaluate the price paid. Is the price reasonable and will it generate a satisfactory return on investment? Look at the price-to-earnings or price-to-cash flow multiple paid for the target. Compare it to what similar companies have sold for. A good CEO will be transparent about the expected return on the acquisition. A bad CEO will talk in vague terms about synergies without providing any hard numbers. As Buffett says, it's not what you buy, it's what you pay. Overpaying is the cardinal sign of M&A. Third, evaluate the integration and synergies. Is the integration of the two companies manageable? Are the promised synergies real and achievable? Combining two large organizations is incredibly difficult. Cultures can clash, systems can be incompatible. The synergy savings that look so good in an investment banker's spreadsheet often prove to be illusory. Be highly skeptical of deals that promise huge cost savings or revenue enhancements. Look for acquisitions of smaller companies in related fields, which are much easier to integrate than massive mergers of equals. Fourth, evaluate the management's transparency. Is the CEO being candid and clear about the rationale for the deal? Do they explain the numbers and the strategy in the annual report in a way that an intelligent layman can understand? Or do they hide behind corporate jargon and platitudes? A CEO who is truly acting in the shareholders' best interests will treat them like partners and explain the decision-making process clearly. Using this scorecard can help you differentiate between a strategic, value-creating acquisition and a foolish, ego-driven act of empire building. It provides a framework for the kind of rigorous business analysis that is essential for long-term investing success. The antithesis of the disciplined seize candies acquisition is a common and destructive corporate strategy known as diversification. The term was coined by the legendary investor Peter Lynch to describe the tendency of companies to grow by acquiring businesses in unrelated fields that they know nothing about. It is diversification for the sake of diversification, and it usually leads to disaster. A classic example is the 1994 acquisition of Snapple by Quaker Oats. Quaker Oats was a stable, successful, but slow-growing food company, famous for its oatmeal and Gatorade sports drink. Snapple was the hot, trendy, new-age beverage company of the moment. Its quirky ads and unique flavors were all the rage. Quaker Oats, desperate for growth, saw Snapple as its ticket to the fast lane. In a fit of deal fever, they paid a staggering $1.7 billion for the company. It was a massive price for a company whose popularity was based on a fleeting trend. The problems began almost immediately. The Quaker Oats management team, experts in selling cereal in grocery stores, had no idea how to manage a quirky, entrepreneurial beverage company that sold through gas stations and small convenience stores. They clashed with Snapple's distributors. They fumbled the marketing. The synergies they had imagined were a mirage. Meanwhile, the beverage industry is notoriously fickle. Consumer tastes changed, and the Snapple fad began to fade. Sales plummeted. Just 3 years after buying it for $1.7 billion, a humbled Quaker Oats sold Snapple for a mere $300 million. They had managed to incinerate $1.4 billion of shareholder capital in 36 months. This is diversification at its worst, a company straying far from its circle of competence, overpaying for a trendy asset at the peak of its popularity, and demonstrating a complete inability to integrate and manage the new business. It serves as a permanent warning against the dangers of undisciplined growth at any cost M&A. The financial scar left by such a disastrous acquisition is recorded directly on the balance sheet. The key concept to understand here is goodwill. In accounting terms, when one company acquires another, it records the fair market value of the assets it has purchased. If the purchase price is higher than the fair value of those tangible and intangible assets, the difference is recorded on the acquirer's balance sheet as an asset called goodwill. In essence, goodwill is the accounting representation of the premium paid for things like brand reputation, customer relationships, and expected synergies. In the case of Quaker Oats and Snapple, a huge portion of that $1.7 billion purchase price would have been recorded as goodwill. The problem is, goodwill must be tested for impairment every year. If the acquired business underperforms and it becomes clear that the expected future cash flows will be much lower than originally projected, the company is forced by accounting rules to write down the value of the goodwill. This goodwill impairment charge is an expense that flows directly through the income statement and can have a devastating effect on reported earnings. When AOL Time Warner took its nearly $100 billion write-down, that was largely a goodwill impairment charge related to the AOL acquisition. It was a public, official admission that they had overpaid by a colossal amount and that the shareholder capital used for the deal had been permanently destroyed. As an investor, when you see a company take a large goodwill impairment charge, it is the loudest possible signal that the CEO and the board made a terrible capital allocation decision in the past. It is the accounting tombstone of a failed investment strategy. Conversely, a company like Berkshire Hathaway, which rarely overpays, has a balance sheet that is not littered with these impairments. This financial cleanliness is a direct result of decades of disciplined mergers and acquisitions. We have now explored the high-stakes worlds of stock buybacks and acquisitions. But the first and often best choice for a capital allocator is much closer to home: reinvesting profits back into the core business. This is the engine of organic growth. However, this is only a virtue if the business itself is a golden goose, capable of earning high returns on the new capital it is fed. Pouring more money into a mediocre business is a surefire way to get mediocre results. The key is to find businesses that can reinvest their earnings at very high rates of return. And for Buffett, the ultimate example of such a business was and is Geico. Buffett's fascination with Geico began not as a billionaire investor, but as a 20-year-old student at Columbia Business School. He had learned that his professor, the legendary Ben Graham, was the chairman of a small, obscure insurance company called Government Employees Insurance Company, or Geico. On a Saturday, Buffett took a train to Washington, D.C., and banged on the door of Geico's headquarters until a janitor let him in. He eventually found a senior executive, Lorimer Davidson, who spent the next 4 hours explaining the insurance business to this intensely curious young man. What Buffett learned that day changed his life. He discovered that Geico had a massive and durable competitive advantage. Unlike traditional insurance companies that used a large network of agents to sell policies, agents who had to be paid commissions, Geico sold directly to consumers via mail and telephone. This direct-to-consumer model allowed them to operate at a much lower cost. They could then pass those savings on to customers in the form of lower premiums. Geico targeted a specific niche of safe drivers, initially government employees, which meant they had fewer claims. The combination of low costs and better-than-average risk selection made their business model incredibly profitable. Buffett was so impressed that he put more than half of his personal net worth into Geico stock after that meeting. He understood that this was a business that could grow for decades. Every dollar of profit that Geico retained and reinvested into marketing to acquire new customers would generate a very high return. It was a golden goose that could compound capital internally at a fantastic rate. Years later, in the mid-1970s, Geico almost went bankrupt due to a period of managerial incompetence where they strayed from their core principles and underpriced their policies. The stock collapsed. Buffett, seeing that the underlying competitive advantage was still intact, stepped in and bought a huge stake in the company at bargain prices. A new management team, led by the brilliant operator Tony Nicely, came in and restored the company to its former glory. Over the next 2 decades, Geico compounded its value at an astonishing rate. In 1996, Berkshire Hathaway bought the remaining portion of the company it didn't already own, making Geico a wholly owned subsidiary. It has been one of Berkshire's biggest success stories, a testament to the power of reinvesting capital into a truly wonderful business. The story of Geico highlights the virtue of reinvestment, but it also contains a warning. The decision to reinvest must be rational and disciplined, not automatic. The psychological bias that often leads to poor reinvestment decisions is the status quo bias. This is our natural human tendency to prefer that things stay the same. In a corporate setting, this manifests as budgetary inertia. Departments and projects that received funding last year tend to receive it again this year. often without a rigorous reevaluation of their potential returns. A CEO might continue to pour money into a legacy division or a pet project out of habit or emotional attachment, even if that division is no longer earning a decent return on capital. A great capital allocator, by contrast, practices zero-based budgeting, at least mentally. They treat retained earnings with the same scrutiny as if it were new capital coming in from the outside. They are relentlessly objective, asking of every potential project, what is the likely return on this investment, and is it the best use of this capital compared to our other four choices: buybacks, acquisitions, dividends, or paying down debt? This requires a willingness to kill projects, to shut down underperforming divisions, and to say no far more often than yes. It means overcoming the emotional desire to keep things as they are and instead adopting a ruthless focus on maximizing the return on every dollar of invested capital. To apply this principle, we can use a decision-making mental model called the ROIC hurdle rate decision tree. It's a simple flowchart that a rational CEO should use when considering any internal investment. Step 1 is to calculate the expected return on invested capital, ROIC, for the proposed project. This requires an honest and conservative estimate of the future profits the project will generate, relative to the capital required to fund it. Step 2 is to compare this expected ROIC to a, quote, hurdle rate. The absolute minimum hurdle rate should be the company's weighted average cost of capital, WACC. The WACC represents the blended cost of the company's debt and equity financing. If a project can't earn a return that is higher than the cost of the capital used to fund it, it is by definition a value-destructive investment. A truly great CEO will set an even higher hurdle rate, perhaps 15% or 20%, insisting that they will only fund their very best ideas. Step 3 is the decision. If the expected ROIC is comfortably above the hurdle rate, then the CEO should proceed with the investment. This is how value is created. It's feeding the golden goose. Step 4 is what happens if the project fails the test. If the expected ROIC is below the hurdle rate, the CEO must reject the project. The capital that would have been used for it must then be allocated to one of the other four choices. Should we use it to buy back our undervalued stock? Is there a strategic acquisition available at a reasonable price? Should we return it to shareholders as a dividend? Or is the best move to pay down debt and strengthen the balance sheet? This decision tree forces a rational, disciplined process. It prevents managers from throwing good money after bad, simply due to inertia or ego. The opposite of this disciplined reinvestment process is the all-too-common pet project epidemic. This is when a CEO, particularly a founder, becomes emotionally wedded to a specific initiative, product, or grand vision, long after the financial results have proven it to be a failure. They suffer from a powerful combination of the sunk cost fallacy, we've already invested so much we can't stop now, and overconfidence in their own vision. They continue to pour shareholder capital into a financial black hole, convinced that success is just around the corner. We see this in tech companies that continue to fund a money-losing division because it was the founder's original idea. We see it in retail companies that refuse to close underperforming stores in their hometown because of nostalgia. This is not capital allocation. It is capital incineration driven by ego. A key part of management analysis is identifying CEOs who have the intellectual honesty to admit when they are wrong and the courage to pull the plug on a failing project, even one that is near and dear to their heart. The CEO's job is to be a steward of shareholder capital, not a patron of their own pet projects. The financial result of a disciplined reinvestment strategy is the single most important driver of long-term shareholder value, the growth of free cash flow, FCF, per share. Free cash flow is the cash a company generates after accounting for the capital expenditures needed to maintain and grow its operations. It is the real tangible cash that is left over for the owners at the end of the year, the cash that can be used for those 5 choices of capital allocation. When a company reinvests $1 of its profit into a project with a high ROIC, it is directly increasing its future earning power. More earnings translate into more free cash flow in the future. A company that can consistently find high-return reinvestment opportunities will see its free cash flow per share grow at an exponential rate. This is the holy grail of long-term investing. The market price of a stock is, in the long run, a reflection of the discounted value of its future free cash flows. Therefore, a CEO whose capital allocation decisions lead to sustainable growth in FCF per share is directly and powerfully increasing the intrinsic value of the business. This is the ultimate financial connection. It's not about accounting earnings, and it's not about revenue growth. It is about the relentless, compounding growth of the actual cash the business can produce for its owners, year after year. We have now examined the 4 key actions of a capital allocator: reinvesting, acquiring, buying back stock, and paying dividends, or debt. But there is a 5th and final pillar to Buffett's management analysis, one that overlays and informs all the others. It is the ultimate litmus test of a CEO's character, intelligence, and alignment with shareholders. It is the quality and content of their annual shareholder letter. To a casual observer, the shareholder letter is just a glossy marketing document. To Buffett, it is a window into the CEO's soul. The foundational anecdote here is, of course, Buffett's own masterpiece of the genre, the annual Berkshire Hathaway shareholder letter. For over 50 years, these letters have been a masterclass in business, investing, and clear thinking. They are required reading not just for Berkshire shareholders, but for anyone serious about understanding the principles of sound financial leadership. What makes them so special? It is their unwavering commitment to candor, clarity, and education. Buffett uses his letters to treat his shareholders as true partners in the business. He doesn't fill the pages with corporate jargon or rosy projections. Instead, he speaks in plain English, explaining complex financial concepts with simple analogies. He openly and honestly discusses his mistakes. In his 1993 letter, he famously detailed his disastrous acquisition of Dexter Shoe, a company whose competitive advantage was quickly wiped out by foreign competition. He didn't blame the economy or his advisors. He wrote, "I made a mistake in assessing the long-term earning power of Dexter. I clearly made a mistake in paying what I did for Dexter." He even calculates the cost of his mistake in terms of the Berkshire stock he used for the purchase, which would have been worth billions today. This level of intellectual honesty is almost unheard of in corporate America. It builds a level of trust with shareholders that is unshakable. Furthermore, Buffett uses the letters to explicitly lay out his principles of capital allocation. He explains why Berkshire doesn't pay a dividend, because he believes he can reinvest the earnings at a higher rate of return than shareholders could achieve on their own. He details the logic behind his major acquisitions and investments. He educates his partners on how to think about the business, focusing them on long-term intrinsic value per share, not on the short-term fluctuations of the stock price. The letters are not just a report on the past year, they are a reaffirmation of the company's culture and its unwavering commitment to a rational, shareholder-oriented investment strategy. They are the gold standard against which all other corporate communications should be judged. The psychological principles that make Buffett's letters so effective and so rare are the antidotes to 2 common cognitive flaws among leaders: the Dunning-Kruger effect and the curse of knowledge. The Dunning-Kruger effect is a bias where people with low ability at a task overestimate their ability. A CEO who is a genuinely poor capital allocator may not even realize it. They are incompetent and unaware of their own incompetence. Their shareholder letters will reflect this confusion, filled with vague goals and disconnected thoughts, because they lack a coherent framework for their own decision-making. The curse of knowledge, on the other hand, affects even smart and competent leaders. They are so deeply immersed in their own industry, with its specific jargon and acronyms, that they become incapable of explaining their business to an outsider in simple terms. Their letters are dense, technical, and impenetrable. They are not trying to deceive, but their inability to communicate clearly is still a red flag. As Einstein reportedly said, "If you can't explain it simply, you don't understand it well enough." Buffett's extraordinary clarity is a direct reflection of his deep and fundamental understanding of the businesses he owns. He has mastered the subject so completely that he can distill it down to its essence. To arm ourselves against confusing or misleading corporate communications, we can use a final mental model, the shareholder letter autopsy. When you analyze a company, make its last 5 annual reports required reading. As you read the CEO's letter, perform this autopsy. First, look for admissions of mistakes. Does the CEO take personal responsibility for failures and poor results? Or do they constantly blame external factors like the economy, the government, or the weather? A great leader takes the blame and gives the credit. A weak leader does the opposite. Second, look for a discussion of capital allocation. Does the CEO explain the rationale behind their buyback program, their recent acquisitions, or their dividend policy? Do they talk about returns on invested capital? Or do they just focus on top-line revenue growth and ignore profitability and returns? The presence or absence of a clear, rational discussion of capital allocation is a huge tell. Third, analyze the language. Is it clear, simple, and direct, like Buffett's? Or is it filled with corporate gibberish, buzzwords, and meaningless jargon? Be wary of terms like synergy, transformation, optimization, leveraging paradigms, and disruptive innovation if they are not backed up by specific numbers and examples. Obfuscating language is often used to hide a lack of clear strategy or poor performance. Fourth, compare their promises to their results. Go back and read the letter from 5 years ago. What goals did the CEO set? What did they promise to shareholders? Then look at the financial results over the subsequent 5 years. Did they deliver? Or was it all just empty talk? A track record of saying what you will do, and then doing what you say, is the ultimate sign of trustworthy management. The path of the 99% is to ignore these documents completely. Most investors get their information from sensational news headlines or short-term analyst reports. They are missing out on the single most insightful document the company produces. The antithesis of a Buffett letter is the corporate gibberish letter. It is a masterpiece of saying nothing with as many words as possible. It might read something like this. In the past fiscal year, we have strategically pivoted to leverage our core competencies in next-generation verticals, operationalizing a holistic and agile framework to optimize our synergistic value chain. Our forward-thinking initiatives in customer-centric digital transformation are poised to unlock significant blue-sky potential, driving a paradigm shift in our go-to-market execution and enhancing stakeholder value across the enterprise. This is meaningless. It is a word salad designed to sound impressive while conveying zero actual information. It is a sign of a management team that is either intellectually bankrupt or is actively trying to hide the truth. When you encounter writing like this from a CEO, you should run, not walk, away from the stock. It is the reddest of red flags, a clear signal that the people in charge are not the kind of clear-thinking, rational partners you want to entrust with your capital. What is the direct financial connection of all this? Why does a clear, honest shareholder letter matter so much? Because it has a tangible and powerful effect on a company's valuation. In finance, the value of an asset is the present value of its future cash flows, discounted back to today at an appropriate rate. That discount rate is essentially a measure of risk. A riskier, less predictable company gets a higher discount rate, which results in a lower valuation. A safer, more transparent, and more predictable company gets a lower discount rate, resulting in a higher valuation. A company led by a CEO who communicates with the clarity, candor, and rationality of a Warren Buffett is perceived by the market as being less risky. Investors feel that they understand the business strategy, they trust the management, they have confidence that their capital is being allocated intelligently. This trust and transparency lowers the risk premium that investors demand to own the stock. This lower discount rate translates directly into a higher and more stable valuation multiple, like the price-to-earnings ratio. In essence, intellectual honesty is an intangible asset that produces a very tangible financial benefit. It is the final, crucial element in identifying the A-grade leaders who are capable of compounding shareholder value for decades to come. So where does this leave us? You have just spent this time not merely watching but absorbing a powerful new mental framework. Before, you might have looked at a company and seen its products, its brand, its stock chart. Now, that has fundamentally changed. You no longer just see a company, you see a capital allocation engine. You no longer just hear a CEO's speech, you evaluate their every decision through the 5 choices of capital deployment. You have just acquired the foundational tool of Buffett's management analysis, the ability to judge the jockey, not just the horse. This is a permanent upgrade to your investment software. But it's crucial to understand that Buffett's system is not a single tool, it is an interconnected network of mental models. Mastering the ability to judge the CEO is a massive leap forward, but it is just one pillar in the architecture of value investing. What about judging the business itself before you even get to the person running it? How does Buffett identify a business with such powerful, enduring economics, what he calls a durable competitive moat, that it can withstand competitive attacks and even the occasional bout of managerial mediocrity? That is the other side of the coin. It's the art of analyzing the horse itself. The video that is now appearing on your screen is the essential next piece of this map. It is the missing link. It is the bridge that connects the principles of financial leadership which you have just mastered with the principles of unbreachable business strategy. It explains how to identify those rare, wonderful businesses that are worth investing in for the long haul. Many people will stop here, content with the powerful tool they have just acquired. They'll feel smarter, more informed, and that's good. But for those of you who are truly on the path to financial freedom, for those of you who are not just collecting tips but are building a complete, interlocking system for long-term investing, the next step isn't a choice. It is a necessity. The journey to becoming a truly sophisticated investor requires a complete mental arsenal. You have just forged the first weapon. Now it's time to build the next. Complete your toolkit. Click and continue your ascent.